Assalamu alaikum everyone. Welcome. We're not going to be singing and dancing, so I hope we can still hold your interest for the panel. The rough time slot for the panel is about 40 minutes. We'll try and wrap up our part in about 30 minutes because we want to leave roughly 10 minutes for Q&A, especially for founders and startup teams who are attending today. We'd love to sort of engage in some questions on this topic, so hopefully we can make it interesting. You already have the intros. I will start with Meenah because she's the only one out of us who was a VC and now is a founder. Usually it's the other way around. Founders exit their companies and become VCs, but she's taken the reverse order. And the question I want to start with is that we've seen literally hundreds of millions of dollars come into our market, especially over the last couple of years. It's been phenomenal, historic, something that we've never seen before. And now, because of the global recession, the entire market has taken a U-turn, or at least a major detour from all the momentum and all the hype of last year, right? So the topic is scale or fail. And now that all of this money has been pumped in, how do you see startups actually using these millions of dollars? And how do you see them progressing sort of to the next level of the ecosystem?
Sure. Hi. Hello, everyone. Thank you so much for sticking around after lunch to hear our panel. I know it starts to get hard at this point in the day to concentrate on anything. And thank you, Shehryar, for starting with me. Here's the thing, I mean, and we've talked about this before also, 9 out of 10 startups globally will fail. Those are the numbers that kind of come out every time this calculation is done globally. I think in emerging markets, the odds are probably even worse in terms of survival. Just because how hard execution actually is in an emerging market such as Pakistan. And execution in Pakistan, I mean, we've all heard about like the ease of doing business index and everything. Execution in Pakistan is actually very difficult. Now, when you're starting a VC business, the game is scale or die. There is no medium trajectory that you can follow if you want to be raising VC money. When you raise VC money, rule number one is probably you scale as fast and as aggressively as you possibly can. Because rule number two is you raise money constantly. To be able to raise money constantly, and that's why so much of the VC startup world is more focused on market acquisition. And you know, as to kind of what the topic today is, the reason a lot of startups also die is because there is such a massive race for market capturing or customer acquisition, we sometimes forget about product market fit. Or even if we don't forget about product market fit, because we need to get to that next milestone to be able to get our next funding round in, we put product market fit on the back burner and we focus so much on simply metrics that are defining market capture for us. And lastly, before I give the mic to somebody else, I think another reason is how rounds are structured. So a great way to kill your startup post fundraising is to raise on terms that almost guarantee you not being able to execute the kind of execution that is required for the next funding round to happen. For example, if your pre-seed round is a $20 million round at a $100 million valuation, the kind of execution you need to show to then get to, you know, your next round at like a $600, $800 million valuation in a country like Pakistan, it is almost guaranteed that you will either have a down round or you will have to shut down business because you won't be able to find money. So there's so many ways to kill your startup. About 70% startups fail post fundraising after the pre-seed or seed round global numbers. And yeah, we're going to see parts of that happen in Pakistan. We're still a new ecosystem. We're all on a learning curve. So much of what we're doing today is completely new. So much of what we're doing today, we're doing for the very first time in our lives. So we're all on that kind of learning curve and that journey. So yeah, scale or die is the name of the game.
So that's the default sort of SOP for any startup. That's a very valid point. To your point about most startups actually failing, especially in Pakistan, right? It's a new phenomenon. And the smaller ones that have smaller rounds, obviously it's tougher for them, but on the other side are fairly large. I don't even know if we can still call them startups. So I'll segue to Abbas from Baikia because he's VP growth at Baikia. He's also been at Uber. He's been on the front lines of actually hyperscaling some of the largest names in the local market. It's a good problem to have as many millions as you guys do in the bank, but it's still a problem to actually survive what's coming over the next 2 years. You've actually gone through a pandemic that wiped out a lot of companies. It wasn't about growth, it was about survival. Now, just post-pandemic, we're facing another downturn, so not the best place to be, but you've been in the trenches. And yes, you have tens of millions of dollars in the bank, but what's your take on how you see your growth, which is Baikia, a fairly established brand, fairly well-funded, but still trying to find its sort of long-term trajectory in Pakistan and the region?
So I think what people often now forget is how Baikia's earlier rounds happened, right? Which were not as massive as you see today. So Baikia's gone through that phase of low valuation, more realistic fundraising numbers, which sort of prepared us for everything that came after, right? And to put it in context, our Series B was $13 million 2 years ago, which number is now being raised at a lot earlier stages, at pre-seed stages, right? So it's 5 years in advance or 5 years earlier. So I think while in the stage of business or the volume that we have or the market penetration we have is relatively larger, but when it comes to funding, to date, we continue seeing our share of the problems that come up with how to spend, how to not spend. And I think building on what you said, right, there's no middle way to this. And there are exceptions to the rule. The pandemic became that exception where surviving sort of became a more principled game, especially for a business like Baikia, which got banned because double savari was off, right? And there was no idea of how do we grow the ride-hailing business, but focus on everything else, which was smaller at the time. I think one of the key things that we've learned from our struggles with money has been how to be frugal as a startup and how to embed that as culture, not just when it comes to the hardships, but how to embed that as a culture when it comes to your normal day-to-day scaling up phase, right? How do we spend money into, so where do we focus on spending money, right? We see a lot of startups. The problem is not raising capital, or hasn't been for the last 2 years. The problem is figuring out where to spend that money, right? And you can spend that money as quickly as you want, but if you don't know what worked or what didn't work, you'll continue spending that money without actually understanding where to scale up or where not to scale up. So what we've done well, and what I suggest to everyone I talk to is, if you can't attribute the spend, you shouldn't spend it. And that involves people, that involves tech, that involves marketing, right? If you haven't figured out a way to attribute out of home, and there are ways to attribute it, but if you as a startup haven't figured out to do it, you should not be spending, right? If you haven't figured out a way to attribute your other brand spend, you should not be spending. There's always ways to figure out proxy of attribution. The second thing is, and this is for us been super important, what you also started talking about is the product market fit, right? I think unfortunately with the focus on spending money and hyperscaling, what people often forget is how do we get the numbers first, and how do we focus on, and not how we focus on what is eventually going to scale or create the eventual value for the market, right? If you're not creating monetized value for your entire chain of stakeholders, there is no point, right? It's going to break in some stage or another. And I think one of the key examples here is when you look at apps that are being developed today, right? There are things people invest a lot of money into. How quickly does your map refresh? How pretty your UI looks, right? What each icon looks like, and not accounting for the fact that in Pakistan, your space in a mobile is a prime real estate. You're building apps for the Western world, right? You're not building apps for Pakistan, you're building apps for India or Bangladesh, but getting someone who's your middle class, upper middle class, lower middle class person to install an app, they're going to have to uninstall another app, right? The second part is, do people in Pakistan care about whether your screen refreshes in 0.5 seconds or whether it refreshes in 2, right? And yes, UX is important and customer experience is important, but if you haven't validated all of this, why are you looking at Amazon best practices or Google best practices or Facebook best practices when they do not apply to your market. So one of the things we generally talk about whenever we bring someone in new to Bikea or when we talk to early stage founders is if you haven't talked to a multitude of customers yourself and your entire team hasn't sat down with 100 customers, 500 customers, 5,000 customers, whatever you think your critical mass is, and ask them 100 questions, right? You will not know what you're building and you will not know who you're building it for. And I think that answers everything else on where you spend the money, right? How do you survive the pandemic? How do you survive not having money in the bank? How do you survive recession? Because if you know who you're exactly building it for, you will know the right pivots, you will know how to attribute that money, you will know exactly what your stakeholders look like, and you will be able to build your product according to that.
Yeah, and can I just jump in before you go to somebody else, Shehryar, will you kill me? It's also the difference between building for investors and building for the actual market, right?
Absolutely.
And so many times we get sucked into building for investors because that's where, like, after seed, that's where my next round has to come from. So I need to see, like, what are people going to fund, and like that's what I have to build. And that takes you sometimes completely away from like exactly all the things that you said we really need to do to survive all of these different things.
Yeah. It's a tricky thing to balance.
Yeah, tricky thing to balance.
Very valid points. So it's, I think the takeaway is it's really good to see somebody at the scale of Bikea still talking about being frugal, because people think that you know these guys are loaded and they're throwing money left, right, and center. But I obviously personally know the culture at Bikea, and I know you guys are really fine-tuning things, and that's a good sort of takeaway for smaller startups. That if Bikea is thinking about being frugal, then everybody else automatically needs to. And the same startups that were being celebrated are now being sort of put down by the general public, especially on social media. A lot of people who are outsiders sitting on the sidelines, who have not gone through building companies, are saying that they've spent their money on fancy coffee machines and offsites in Bhurban or whatever. But I think every startup, regardless of the scale of the funding, is really trying to crack a difficult problem. Yes, there are exceptions to the rule, very valid point. There was easy money in the last couple of years. It was easy to raise relatively. People have made products that are kind of really stupid and laughable, and they will most probably die a painful death. But the majority is actually trying to crack some key problem in a very difficult market, which is not really easy to operate in. So the VCs are to blame, and it's all your fault, Misbah, because one side obviously are the startup founders and the memes about buying expensive coffee machines or whatever. That's exaggerated. But the other side of the equation is obviously now, because there's a downturn and the hoopla around building the next unicorn out of Pakistan has died down, people are asking the tough questions that, why did local as well as foreign VCs pump so much money into the market? And why did they back startups which apparently from the sidelines never really looked as if they'd ever reach product market fit, right? So what's the VC lens on this? Pre-2021 hype, and now post that, looking into the sort of next 2 years?
Yeah, that's a great question, Shehryar. Thank you. And I think for us, every VC doesn't have the same perspective. So I will start by saying that there are local players that have different perspectives. There's a difference between international and local perspectives. People who are on the ground who understand the market reality of building a startup in Pakistan, which is very different from building it in Silicon Valley. I always like to say that investors in Pakistan are probably not going to invest in a pizza making robot anytime soon, because at our doorstep we have so many big problems that are just waiting to be solved. So I think to your point, pre-2021, for those of us that have been in the startup space for a decade or so, most of us included, we've seen how the market has slowly been getting strengthened by a lot of the ecosystem players. Jahan has been a key figure there, my partner Kulsoom with Investor Innovate. These people have been building, and now the NICs more recently have been building the market for startups. What suddenly happened in 2021 was there capital in outside markets looking for alpha, because they were stretched in their markets, they were tighter markets, and so they were looking for higher risk, higher reward markets like Pakistan. So Pakistan and a few other startup spaces actually picked up. There was a lot of interest in countries like ours. I think people finally woke up to the opportunity. We keep throwing these numbers around, fifth largest market, 100 million broadband users, large majority of young population using technology. But what it really means is, I think for people outside, they recognize the opportunity that Pakistan presents in terms of the market that's there. So I think those two things happened. I think one other thing that happened was founders became, more experienced founders started coming into the space, either people that had been in corporates or banks, or people that had worked with startups like Baikia, like Daraz, like Kareem, came and started setting up their own company. So I think there was capital was attracted to founders like this and markets like Pakistan. And so there was a sudden spike in interest, and for those of us that understand economics and for those of us that have common sense, it's just demand and supply. So when the demand goes up, the price goes up. And so it became a founders market where a lot of founders were able to demand pretty crazy valuations, where some of us on the ground were like, I don't see how this is a $15 million valuation at a pre-seed stage. And I think there was a difference in perspective, like I said earlier, between different investors in Pakistan and also local versus international. So I think what was happening is a lot of international players were looking at Pakistan opportunistically, and they came in. The check size may have been large from our market's perspective. It may not have been large for funds that were huge. For those of us that are focused on Pakistan, we've always taken our time, and we always hold ourselves to this sort of idea that we don't want to do deals out of FOMO. And I think that's really important for us. There have been deals that have been done out of FOMO in the market. We all know what some of them are. We also know that valuations have been hyped. But I think for a lot of us who understand the ground realities, it's important to identify the founders that are actually not only looking at a path to profitability or the product market fit, but are solving big problems where the opportunity is huge. I think you don't have to be profitable on day zero. Most companies are not. But I think that path to profitability is important. So I think for us, we always look to see like what are the founders thinking a little bit down the road. Like when is this becoming unit economics positive? It doesn't have to be that on day zero, but that sort of idea down the road of like not just throwing money like you were saying, Abbas, like it just shouldn't be a leaky bucket where you're just throwing money because you've been able to raise money. And that party had to end at some point. So I think even before the recession or the downturn, if we're not calling it the R word, I think we were expecting a bit of a correction anyway, because last year was a little crazy in terms of that spike. I think the tightening of the global economy has kind of pushed that forward and sped it up a little bit. And so I think a lot of founders are now going back to basics, which is not a bad thing at all. I think most people are going and saying, how do I make my business profitable, if not today, in 6 months, because I can't rely on the fact that money will keep coming. And one thing that we say is that, and I know you tweeted about this recently as well, Meenah, and Kulsum and I have been saying it as well, is like, in Pakistan, have never had that much capital. Our founders, our entrepreneurs know how to make businesses work without money being thrown at them. And we'll hang in there and make it work. So I think for us, it's kind of like it's that mindset of jugaad or making things work when you don't have access to too many resources. And I think it's going back to a bit of that and really focusing on fundamentals, which is not a bad thing, to be honest. To your point about people who, from the outsiders looking in, whether it's people that are not in the startup space or people that are not in the tech space, it's very easy to point fingers and say, oh, you laid off people because you didn't do X, or you raised too much money and you didn't do X, or you put money on the wrong side. Like, these are stories that are, that the teams know better than us. Sometimes even the investors don't know exactly what's going on. So I think we need to have an understanding and an empathy that there's a lot going on in some of these companies, and that people are looking to readjust to the new reality in terms of the economy, but also the fact that maybe foreign money at least will be slowing down for a while. I think for those of us that invest in Pakistan as the core business, we'll be here and we'll continue to invest. I think we just need to be a little smarter about which business models to back, especially with a little bit of a tightening in the economy.
Thank you. I think that was a very, very appropriate summary of what's happening, because again, there's a difference between people who are on the ground and people who were either seasonal investors or FOMO investors, or whatever category you want to call that. And I think another key point that I'd like to make is that a lot of people who are not in the industry and are sort of observing this as a flash in the pan. And I really want to disagree with that. This is not a flash in the pan. 2021 was not just an anomaly, and now we've gone back to some level 0 of activity again. There's been a step change. We've moved on to the next level. 2021 was insane, even for the people who were in the industry. We never ever imagined we'd be reading that in a single year, $380 million was invested in Pakistan. It's insane even right now. But there's been a step change, and there's a permanent change in the maturity of the ecosystem. And yes, there's a downswing, but when we continue onwards over the next 2 years and beyond, it's going to be at a much higher level, at a much maturer level of the ecosystem. With that, before I bring in Abbas, I think one thing that's happened is that because so much money came in, which nobody was used to, hello? I think there was an artificial, obviously accelerated growth of the ecosystem. And one thing which is still missing to a great extent is that we have not had organized, structured angel syndicates in Pakistan. And that's a stage that through which every ecosystem has gone. And it's a question that myself as a VC, when I'm talking with foreign VCs coming in, that's one of the first questions that we get asked. That, where are the local angels over the last 10 years? Where are the local tech CEOs? Haven't there been any exits? Why don't people invest inside Pakistan from the tech sector? And although there has been investment, obviously we are all aware of that, but it's been in bits and pieces. It's very ad hoc. It's very under the radar, and it hasn't been a source of capital for founders that, once you've run out of friends, families, and fools, there need to be some sort of angel networks you can tap before you can go to VCs, before you can go to institutional funding. So I think Abbas, having built multiple tech companies as a founder, having exited, having done JVs with companies in the US, you've been on that side of the table, and then the last 10 years or so you've been active as an angel, but again, not through a structured syndicate. So Abbas, I was saying there's a major link which is missing, and that's early stage financing, because there aren't a lot of early stage VCs in Pakistan. And before then, in the first 12 months, most startups implode because they don't have access to angel funding. And it's a sort of credit to the founders that they've survived despite structured angels. So I think we've had this discussion that there ought to be a KarachiAngels.com or a MaymanAngels.pk or a MargalaAngels.com, which is, some sort of a structured website where as a founder I can go and I can access a syndicate that meets every 2 weeks, and I can go and pitch to them for small ticket sizes of anywhere between 25 to 100K, and that's going to shore me over the first 12 months. This culture hasn't been built up. So what's your take on that, first of all, and how do you see the increase in angel activity over the last 2 years, now that the market has been validated, not just for local angels, but also for expats?
Yeah, a great question. I think I'll answer the last one first. I think the good news is that we now have a bunch of structure-ish syndicates that have popped up, right? There's Wall City and Sarmai Kar Kapna, Operator Angel hai. So, and there are a few that are in the making, that they get to hear about. But, how do we get here? So if you rewind back to 10 years, I was one of the foolish, proud foolish to back people up back 10 years ago. And I think a number of things had to be true for angels and syndicate to come together. Number one, most of us were very hands-on operators, CEOs, trying to make money so we could invest that money, and also to learn how to be founders. And part of the angel syndicate is not just kind of the early check size. I mean, I'm a very hands-on, buddy or coach with the founder. So unless you go through that cycle, right, of angels who could commit to you both money and time becomes very difficult. So ek to ye tha ki that layer didn't exist, right? Took a while for that layer to be developed. The other important factor was that I believe to be true is that had to be critical mass. There had to be critical mass of the ecosystem for the founders to be fellows, to come, fail, for the system to mature enough to say, hey, you know what? Now we have at least a baseline. We understand who to invest in. The thesis became much more pronounced. वो भी नहीं था. So when I remember first investing, there was no baseline. I couldn't understand how do I evaluate them. So a lot of times you would value them too high, or you check a big chunk out of it and let's say, hey, you're a VC, not an angel. So we went through the whole cycle, right? So all that correction, right, of understanding both from the founder perspective, the market perspective, and for some of the angels, by the way, were a little reluctant as well. They were like dipping their toes. It's like, we don't want our name to be associated with this because we don't know how it's going to pan out, because there really wasn't any sort of success stories that came out. And it took a while, right? It took like 5, 6, 7 years and multiple dozen, bad investments to really figure out, right? What is the ask of a founder? What's the role of an angel? And frankly, the education for the angel itself, right? So now we do have really good resources, schools. We have people who can coach us as well. And previously it was really kind of done out of the blue, once in a while, sort of a thing. So I think those factors really contributed to where we are, where now we do have more structured programs, and I think we're going to see more and more along that side. The other thing, I said this is a tremendous time to be an angel. We do see a gap in the next couple of years. There is going to be we're already seeing some retreat from a foreign investment perspective. So for angels to step up and fill that early gap, take some of the early risks, where we have a pretty active angel ecosystem where you can come and learn and join the, sit at the table and learn from us is tremendous opportunity for us.
Wonderful. So all positive signs generally, because we're seeing all of these people who were below the surface or under the radar now surfacing and making formal syndicates. And to your last point, I think that's really important because there's now more space for not just angels, but smaller VCs, as well as an interesting phenomena, which is family offices and corporate investment arms or investment arms of large corporate groups that frankly didn't really have the kind of space that they would have liked over the last 2 years, right, with the heavyweight VCs coming in. And now this space is vacant for these people to actually make deals on more rationalized valuations, which kind of are more palatable to them because the crazy valuations were beyond them, right, even if they had the checkbooks ready.
Right. There were valuations. There was just simply a matter of getting money into Pakistan. A lot of the folks that we work with, I've got a budding system, syndicate. A lot of them are based out of US. First, there was no narrative, right? So where do you invest? How do you invest? How much time do they need to commit? What's the checks and balances? So all of those compliance and legal issues, when they got resolved, it became a lot easier. So I think it's now a little bit, the groundwork has been laid for family offices. They've been a little bit risk averse and gone the VC route mostly, which makes sense. I think the risk has to be shared by the angels and the syndicates. But I think nevertheless, I'm seeing a lot more inflow of money from, for first-time angels who want to invest in Pakistan. People who are kind of, our age, who kind of now made money in the US and want to give back to the country.
Wonderful, wonderful. Thank you, Abbas. I think with that, we'll wrap up the comments and open the floor to questions. We have about 8-9 minutes left, so we'd love some founders and some startup teams to pose questions.
Well, that's okay. We can share the mic.
We can share the mic.
Does anybody have a question? On the right, please. Hello. Thank you very much. Very insightful. I'm going to ask a very different question. I don't know how this is seen. I've moved away from the speaker since I could get feedback. Do you guys think that having a very personal connection with the founder as a VC, knowing the founder personally, and also the fact that the founder is very well connected and you think the founder is going to do big things, is one of the prime reasons why you guys invest? Because the reason I'm asking is a lot of other startups that I know who may not know the right people in the ecosystem, they're trying to raise too. But usually you see a lot that's very well connected getting there. So just wanted your comments on that.
Thanks, that's a great question. I think it's important for us to separate having faith and building a relationship with a founder from access. I think those of us in the space are continuously trying to make sure that we don't only look for founders within our circles, whether it's education circles or social circles or communities. I think it's important when you're going to tap into Pakistan's potential that you have to go far and wide. Just because someone didn't go to the college that I went to or didn't work where I worked doesn't mean that they don't have that potential. So access is important, and I think that's an important onus is on VCs and investors, but also on ecosystem builders to provide access. Most of us, I know Khurram is here as well and Shehryar as well, most of us have emails that you can write into, a form that you can fill out and be able to reach out to the investor, sharing a bit of your company, send a pitch deck to, and so access is something we're all trying to improve. I mean, I know Katalyst is doing that as well. I think the other thing, however, is building the relationship with the founder. And I don't think it's important for you to already know the founder, but I think it's important for you to be able to build that conviction on that founder and their ability to execute. We all know that Pakistan is a really hard market to build in. It's a very high friction market. And so it takes a certain kind of founder that is not just visionary, because vision is very important, but is also going to be able to execute. So I think for those of us that are early stage investors, I2I invests in pre-seed and seed stage companies, building that conviction around the founder is the most important thing. Very soon after that is the business, is the market opportunity that they're trying to solve for. But if the founder or the founding team is not strong and we can't build that conviction, then why are we even looking at this as a potential investment? So I think to answer your question, I'd separate that into two. Access is separate, and building that faith and conviction in a founder is a different thing. I don't know if anybody else wants to add to that.
Okay, so I'll just answer that question also, because I've been on both sides of the table as a VC and then also as somebody who raised investment. When you're investing, what you're looking for is an asymmetric risk profile. What does that mean? Startups are inherently high risk, and they're also seen as high reward. So 9 out of 10 will fail, but the one that will succeed will pay me back for everybody that failed and more, right? So when or any investor is evaluating a founder, we're trying to see what are the little things that we can check off which decrease risk for us when we put our money into that, into that deal. But the return profile remains phenomenal, right? So when I, as a founder, am presenting to investors, I know this already. I know everything that I say and do and look like and present has to, in their head, decrease risk. They have to look at me and see phenomenal returns and the lowest possible risk that they can get in a deal of this sort, right? Knowing someone already decreases risk. Knowing somebody and the work they've done, unless they're like a terrible human being, then it doesn't decrease risk, it increases risk. But knowing somebody has done phenomenal work in the past decreases my risk because I know how they execute, right? So if you're a founder who doesn't have those connections and those networks, you need to remember this one little thing, and you need to work on your own self and your branding and your profile and build credibility so that you know and you can think of all the little things that you can possibly do to decrease risk in the mind of the investor that you're speaking to. I mean, I hope that makes sense.
Yeah, just a quick comment on that. This very, very valid question. It reminded me of a tweet where somebody had tagged a lot of the VCs, and the question was, can I pitch to you guys in Urdu? or do VCs listen to pitches in Urdu? And this perception of this clique or the old pals club or whatever of Lums, ex-McKinsey, ex-Goldman doing a fintech in Pakistan, HSN, grammar school, whatever, Pakistan elite who's connected and we know each other and we're funding each other. If you look at the profiles, it may be true in the first batch came over the last 2 years, but that's primarily because those people were already socialized to Silicon Valley, Y Combinator, the whole culture of startups, and maybe it was just easier for them to actually take that jump and take that risk. But from a VC's perspective, what Meenah was saying about minimizing risk and the Urdu comment, right? As a VC, if we meet a team and they have a really compelling product, and as a founding team, they've got amazingly relevant product market fit and founder product fit, and they're starting out or they've got great metrics, we would be crazy not to invest in them just because they don't fit a certain checklist, which is actually a red flag in a lot of places, where if you go for that typical checklist, a lot of times that increases your risk because it's a sort of a confirmation bias, right? So now that the culture is there, now that a lot of people, and I'm obviously generalizing, but if you were to take a typical, stereotypical Urdu medium Desi founder, those people never ever thought that they could raise millions of dollars just based on their experience and idea, because nobody did that in Pakistan. But now they've seen checks written just on the potential of founders, and those people are now front and center and much more aggressive than the typical sort of, burger founder that we make fun of. Last question, please. We're almost out of time.
What? Thank you for this opportunity. Just if you put a founder's hat on, what's your outlook? What's your outlook for access to capital? Looking at it from a founder's perspective right now, as we sit today, I think I looked at a few days ago, Pakistan sovereign risk was trading at a 30-35% discount, which means risk-free. If you just want exposure to Pakistan dollar denominated, you can earn about 15-16% annually, right? So if you tack onto that, venture risk and return expectation, all of that, you're hitting 25-30% return expectations. So you think especially international capital is going to dry up because of that, where Pakistan sovereign risk is trading at? Or do you think there's plenty of capital that's available for startups that are doing well, growing, has great teams, great business models?
Sure. So putting my founder's hat on, I think what Misbah said earlier, there are some people who are on the ground, not just physically, but who are committed to Pakistan in the long run as investors. Those people will still be around after 2 years. They're aggressively deploying over the next 2 years, and nothing much has changed. In fact, I know a lot of investors who feel that now is the best time to invest because there's blood in the streets, and the seasonal investors have left, or they've put their checkbooks in the drawer and are waiting it out. As far as access to capital for the founder, it's definitely going to be harder than it was in 2021, regardless of the vertical or regardless of what you're doing. But I think the later stage companies are more affected simply because of the multiples that they had in mind, and simply because of the timelines that their seasonal investors had in mind, that if they're going to come in a quick seed round or a pre-series A, and within 12 to 18 months there'll be a 5x or a 10x and inflated series A, and partially they'll exit, or they'll exit at a much safer series B, right? All of that quick maths is out the window. It's back to the basics, as you know. It's back to a path through profitability. It's back to fundamentals. Whoever has that covered, I think there'll be more than enough money chasing those kinds of founders.
Thanks. I'll just add to that. I think it's about timing. So I think the money will come, the markets will bounce back. Pakistan is not a country whose potential has gone away. I just think it's about timing. So I think founders that are already in businesses, and maybe Abbas, you can comment on this as well, are really looking at how do I make that dollar stretch even more? And in that context, going from 160 to 215 may not be a bad thing. But I think it's about really doubling down and focusing on the fundamentals, like Shehryar said. I think the other thing is that there are investors that have invested in similar models which can do pattern recognition and pattern matching in markets that they may have, for example, done a fintech in Brazil that is similar to Pakistan in terms of opportunity that may still come in. I think right now people are in a bit of a shock. I think once the shock of the market slowdown sort of wears off, people will remember that those that have invested in the stock market made 300% over the last 2 years. So it doesn't really matter agar usme se one third has gone down, they're still up 200%. So I think once that scarcity mindset is going to settle in, people will start coming back to the market. I think Pakistan will be a little lower on the list of priorities for a while, but I think the people that come back soonest are going to be those that are going to start pattern matching with what they've invested in other markets and seen that trajectory and looking at Pakistan as that opportunity. I don't know if you want
Yeah, just one quick thing to that. Just doubling down on what you said. I think where the path to profitability lies or where the unit economics are favorable, we are seeing either early stage founders still have access to that capital, or startups that have done round A, round B, done post pre-seed, getting their current investors double down in their investment, right? So the red flags are where the current investors are not confident of their investment, or the seasonal investors that are now writing off their investment in Pakistan simply because they no longer believe in that business anymore. But I think where investors are putting in a good chunk of money in terms of doubling down, that's a good indication of that access to capital existing from serious investors into serious business models, right? And I think that's a good sign for the maturation of the ecosystem, as you mentioned as well. And that correction was bound to come at some point. It's just come a little bit quicker than people anticipated and a little bit more abruptly than people anticipated, which is why all the noise around it, right? But these corrections have happened in other markets where 10 years ago in Southeast Asia, 20 years ago in Silicon Valley, all of this has happened. Capital has become harder to raise. More innovative business models have been required to raise capital. More paths to profitability or a more robust model has been required to raise capital in those markets as they've matured. And we're just becoming a little bit more abrupt in our journey. So yeah.
One last question.
Yeah. Following the condition that I have in our economics, right? And
Sorry, we can't hear you.
Can you hear me now? Yeah. So the economical condition that we have in our country for the boy, and following the trends that we have in our ecosystem for startups, do you think that the investors are losing?
We can't.
No, still can't. Do you think that the investors are losing their interest and their, and their money in the ecosystem of Pakistan, or mainly startups? Do you think that they will be investing anymore? Or I totally believe in convincing the investor and pitching them to them, but I think, mainly because of the economic condition, maybe the investors, following the Pakistan are losing their interest in investing. If that makes a valid point.
Considering the economic recession, will investors continue to invest?
You want to take it? Gee, I think we partially kind of answered that, but just to your point, other than the global slowdown, Pakistan itself is going through obviously a lot of turbulence, and we can't just ignore that. The political turbulence, the economic turbulence, there will be a cycle where, for example, let's say once the elections are announced, there'll be some stability. Once the IMF deal comes in, there'll be some sort of, so there'll be these milestones, right? And even businesses that are based in Pakistan, traditional businesses, they're in a wait and see mode. But your question about will investors still be interested in Pakistan because of the turbulence, I think that's just a temporary pause, and the market is massive, the potential is massive. If you were interested in Pakistan last year, you should still be interested in Pakistan, and there are investors that still are. A lot of foreign investors have moved back to just safer markets that they understand better, but that also is temporary. Whether it's a year or 2 years, nobody knows. They're bound to come back, and by that time our ecosystem will be even maturer. So, like I said in the beginning, it's not a flash in the pan that happened last year. It wasn't a one-off. We haven't gone back 5 years. We've gone to the next step, and the graph is definitely headed towards the right place.
Can I add one quick thing to it? Just very quickly, I think you also have to look at Pakistan in the global context, right? People sort of forget that at times. People have, there are business models globally that are coming under pressure, shutting down, whether that's one industry or another, right? And Pakistan is part of that trajectory. So it's not something there are specific things about Pakistan that also affect it, but there's also a global trend right now, right? Or global risk aversion right now that's happening. And if someone is pulling money out of Europe, or someone going through JVs or exits or declaring bankruptcies or laying off people, doesn't mean that investors are losing interest in all markets globally, right? And Pakistan is part of that context. There will always be specific reasons about Pakistan, but there's also a global context in play.
Yeah, and I think at the seed level or pre-seed level, we've seen the reverse. I mean, at least I'm seeing the reverse, where there's a lot more deal flow that's happening. And we're not going anywhere. So I think they slow down, of course, because of global sort of trend in later stages, but the seed and pre-seed angels are still very, very active.
So with that, I think we've overrun our time. All of us are available offline, especially for the founders who would like to chat after the panel. Really interesting discussion as far as I'm concerned. I hope it was productive for everybody else. Thank you so much for your time.